Joining us now is Deutsche Bank CIO of the Americas, Deepak Puri. It's good to have you. What do you think gets the Fed cutting rates next year?
Yeah, it seems like the recent Fed speak has given some credence to what we've been saying and what our outlook is for next year, Sarah. I think it's a bit premature to think it's a first quarter phenomena. Most likely, it's somewhere in the middle of the year. We are thinking June is the most likely time when the Fed comes up with the actual rate cut, the most blunt instrument they have. You have to look at labor market dynamics here, and the labor markets is still very tight. So it's very difficult to assume that just because you have this disinflation traction pretty much well entrenched, but the Fed is going to start cutting. I think the good thing here is that the Fed's conversation has pivoted. They're no longer talking about how high to go or how many rate hikes to make, but how long do they stay on the sidelines and how long the pause is going to be. I think so that's positive for the markets. And actually, you're seeing that happening in the two-year, Treasury rate movement.
So I guess how much more room is there for yields to go down from here, giving some support to stocks?
Yeah, I think on the two-year side, you can still see some downward revisions as the three rate cuts, which we are a little bit off consensus. The market expecting another 100 basis points of rate cuts from now till next year end. So we are calling for one less, but we still expect the two-year to end next year by around 395. The 10-year is a little bit more trickier given the deficit that we stare at and all other issues regarding, other investors buying U.S. Treasury and the appeal of U.S. Treasury at this point. So the 10-year probably stays around 420 for us, but it's really the two-year that should go down. So a little bit of a curve steepening from here on.
Hey, Deepak, so no recession, three rate cuts. You got the terminal rate reached. You're above 240 on S&P earnings next year, and yet your target's 4,700. Why won't there be more enthusiasm for equities if all those things happen?
Yeah, so it's a combination of you need this perfect cocktail of events to take place for markets to really go higher, and that at least from our perspective, that catalyst might be somewhat missing. 4,700, it's moderately constructive, but not euphoric. I'm seeing a lot of projections from a five handle. I think for that to happen, you need to really have a confluence of events that'll be a perfect mix. A soft landing scenario, 100 basis point of rate cuts, and EPS growth of double digit for 2024. And I think any one of those disappointments can really bring the risk sentiments down. And last but not the least, we are also really thinking of a supporting energy market dynamics, and nothing really changes Fed projections and also inflation forecast than the oil market. So I think there are a lot of what ifs, Carl, for that number. And we are somewhat more conservative, and 4,700 for us seems to be a much better place to be at.
You think there are some interesting value plays in Europe, I think, and internationally. And I'm curious about why, with such a benign outlook in the U.S. Do you think Europe can also stick a soft landing?
Yeah, that's really our expectation, Sarah, that the Europe, they grow at a, somewhat muted pace, 0.7% next year. But when you look at really wage growth, somewhat similar story that what we have seen here in the States this year. The consumption is a big driver. EPS growth for European stock indices is double-digit earnings growth. And then when you're comparing growth, the value, the PE multiple at which you're buying growth is a little bit more appealing to us for Europe. So I think somewhat of a barbell strategy where you still stick with the growth sectors here in the States, but then you sort of also complement it with the value sectors from Europe, and maybe even some other parts of the world might be a good way to navigate 2024.